into any sort of endurance sports, cycling, running, anything mad?
Yeah, quite into cycling and running.
Oh, good.
I've done one marathon. I think I'm probably more of a 10k than a marathon.
Love 10k.
Done that.
Yeah.
10k. As well.
5k is my speciality.
Yeah.
Slowly.
Not mega endurance.
Solid 35 minutes.
Exactly. Nothing wrong with that. Casual.
What sort of cycling? Road?
Road. So my husband's really into, he does sort of stages of the Tour de France. So we'll kind of do 50k and just, go out into Kent from Dulwich.
What's the road? What's the group called in Dulwich? The Dulwich.
Oh, I've seen them. They all have
blue,
matching
they've got a light
sort of
blue
wrapper.
kit.
Yeah, I don't know what they're
I can't
called.
remember what they're called. Dulwich.
Do you live near there? Or you've heard
No,
of them?
I live out. I live out in Esher, but
Okay.
they all come out to the Surrey Hills.
Okay, so you see them. Yeah.
Yeah, there's
No, I see them in
trains of cyclists coming past
Every
in
weekend in
different colours.
Berkshire. Here they all are, like. The pelotons are out. Extraordinary.
Well, we're virtual pros, don't you know?
Well, we're pros at everything, aren't we? Should we, good to go. Ladies and gentlemen, good afternoon. Welcome to Taking Stock After the Bell, episode 16. We are delighted to be joined by Charlotte Young. Charlotte is the Assistant Fund Manager of the Trojan Fund and Personal Assets Trust and is a Fund Manager of the Trojan Ethical Fund. Charlotte joined Troy Asset Management in 2013 from Ruffer Investment Management, where she worked as an investment associate. Charlotte graduated from Cambridge University with an MA in Modern Languages. It's really interesting. Charlotte holds a CISI diploma and is a CFA charter holder. Charlotte, welcome.
Thank you.
Nice to have
Thanks
you
for
here.
having me.
We also have James Hughes with us as well, as per usual. It's really interesting background. I always think it's quite fascinating when someone comes into finance and investments without the traditional kind of economics, finance, investment kind of undergraduate degree. Do you think that your background and your training in modern languages has been helpful? Does it help you think a bit different, do you think, about fund management?
Yeah, I think so. I'm part of a charity which is trying to get more women into investing, and a big part of what we're trying to teach people is you don't need to do an economics degree. And I think a big part of that is the way you analyse, the way you communicate. So I spent 4 years reading French and Latin literature and writing essays and assimilating a lot of information, but then actually forming an argument and being able to articulate some sort of cogent argument. And I think that's basically what our job is. But you need a level of numeracy with that as well. I think the sort of qualitative side of things often gets downplayed, and that definitely helped from the degree.
And how was it going from modern languages to studying for your CFA?
Quite a breath of fresh air, actually. Multiple choice was a nice light
Multiple
relief,
choice.
I would say.
Yeah. Did you not get tripped up by the kind of options, derivatives, housing, bonds stuff in level 2? I mean, level 2 was just
Yeah, I really like bonds, so that was my favourite paper.
well, we're going to talk about bonds, so that's
Good.
useful. And we've got the chart here on the screen of the Trojan Fund, which you co-manage alongside Sebastian Lyon, which has been going since 2001, in blue here, and we've put the UK equity market total return in red. And I did actually put this chart against the global equity market, and it doesn't look entirely dissimilar, to be fair. Clearly, the performance is very good. And one thing that sticks out from the chart is how the fund has managed to avoid those deep drawdowns when equity markets have gone through difficult periods. 2002-03, obviously 2008-09, a few wobbles in 2015, and obviously the COVID setback as well. Just talk a little bit about how you've managed to do that, what the philosophy is, where that sort of edge, if you like, has come from.
Yeah, I think it's the most important part about the mandate. So the mandate was set up in 2000. The company was set up in 2000. The mandate started in 2001 for one family initially. So Troy was day one a family office, and very much the brief that Sebastian got was, "Don't lose my money. I don't care what the market's doing." And this was not a relative return fund, which was quite unusual in the early noughties. So really just being able to take a step back, and frankly, if we don't want to be invested in equities, we don't have to be. And it's much better for us to be early than to be late, because it's that consistency of returns. Lord Weinstock, who was Sebastian's co-founder, said, "I don't want you coming to me when the market's down 40 and you're down 15, that's not a success. So it's really minimizing those drawdowns, and the way we think about it is don't take any risk unless you really think you're being paid to take that risk. Clearly we need to take risk, that's what investing's about.
Yep.
But when there's no margin of safety, then we can happily stay on the sidelines and be patient.
And judging by the chart, recent performance is, clearly not been. You can see that sort of blue line has flattened out a little bit as the equity market's made some progress. Does that sort of suggest, reading between the lines, that at the moment you don't think you're being paid to take a huge amount of risk?
Yeah, exactly. So, I mean, last year, it sort of depends which market you look at, but as you say, last year was actually good for the UK, thanks to energy. Terrible for the US because of tech, and sort of slightly different this year in terms of, obviously, tech's really helped the US. And in both years, so last year we don't own any energy, so we were down a little bit. We were down just over 3%, and this year we're up a little bit. We do actually have some tech. And that's been a positive contributor. We can kind of talk about the different moving parts, but effectively we've got a quarter of the fund invested in equities now, which, exactly as you say, is reflective of our view that there's no hard landing, let alone even just a mild recession, we don't think, priced into equities, both in terms of valuations, but also earnings consensus is effectively for earnings to just keep growing 2024, 2025. And valuations are on a lot of metrics much higher than their historical averages. So there's a long way to fall if that valuation comes down to a reasonable level and the earnings come down as well. You kind of got a double whammy.
Sure.
And you're getting paid to take risk in bonds. So that's why we've got a third of the fund, over a third now, in index-linked bonds, which are pricing in higher rates, not pricing in higher inflation.
And on that equity weighting, you said you got 25% of the fund in equities. How does that compare to the range or the average or typical?
Yeah, so the average has been just over 40. In terms of the highest, we've had 72% in equities just after the financial crisis. In recent years, we were as high as the mid-40s just after COVID. And we've rarely been lower than 25. So it's really the bottom end of the range. Really think sort of 25 to 75 is the range, but because of the way the fund's set up and because of the sector it's in, we can technically be 0 or 100. We're never going to be 0. We acknowledge we can be wrong. We also still really like those businesses that comprise the 25%. We still want to have a foothold in them and be able to lean in and add to them when the valuations are lower.
Sure.
And how it looks like almost the best relative performance was actually during COVID.
Yeah.
Did you have very low equity exposure going into that period?
Yeah, exactly. So start of 2020, we obviously, we were not in that minority of geniuses that predicted the pandemic, unfortunately. But we were really concerned about valuations at the start of that year. And we also saw that the economy was already rolling over, even before COVID.
Because the yield curve was inverted at that point, wasn't it, before the pandemic?
Exactly. And you could just see global growth was slowing. We just weren't being paid to take risk. And it's that classic case of people ask you, what are the catalysts? Sometimes you don't know, such as then. Sometimes there doesn't even have to be one. We were talking about the early noughties. There wasn't, the market turns down. It's a change in narrative and perception and risk appetite amongst investors. And that can happen just because valuations are high.
Well, the early noughties one was interesting, wasn't it? Because the first 6 or 12 months was about the highly rated tech stocks getting nailed. Then there was 9/11 and a recession, and then of course you had Enron and WorldCom, didn't you? So the three sort of followed each other.
Yeah.
And there was just various, valuations went from 25-30 times PE to 10, 12 probably at the bottom, wasn't it? But you're right about the catalyst thing. I always think people talking about catalysts is slightly.
It's hard to predict in advance, but if the valuations are high, it doesn't take a lot to knock it off.
It just takes anything really, doesn't it?
Yeah.
So then, if we sort of turn to some of your kind of macro views, and we sort of discussed this a few weeks ago when we sort of met, but when I think I've got a chart here of inflation in the US going back to 1960, which is before most of us, and we're around in blue, and we can see the last 30 years inflation has sat around that sort of cosy 2% level, plus or minus a little bit, whereas actually historically it's not really been that way. The 60s and 70s inflation sat much higher and much more volatile. In red, we've got a chart of U.S. Federal Reserve, the effective base rate in the US, which clearly was very high into the 70s and early 80s and has been coming down kind of ever since Volcker put rates up to 20% in 81 or wherever it was. That sort of last 20 to 30 years has sort of been a bit of an anomaly, isn't it, if we look at long-term history. And we've talked about in the pod before, we've talked about the entry of China into the global trading arrangements and WTO and globalization, technology, just-in-time manufacturing. Do you want to sort of touch on some of your views as to how this sort of, what you're thinking about inflation from here, and has the world changed, and are we going into a different environment, I guess is the question.
Yeah, and it's all those disinflationary forces, which a lot of them are, particularly since COVID, but even before, you can see that there's a sort of structural shift. So for example, with globalization, we were already seeing, and this again kind of comes with the rise of populism, and we were talking about it when we were talking about Brexit, but there's this increased nationalism, which is clearly in the aftermath of COVID accelerated. That's causing reshoring, much higher manufacturing spend, for example, in the US itself. And a lot of that is not necessarily good for growth globally, but it's definitely more inflationary. We're looking at just manufacturing spend in the US and particularly construction, non-residential construction has been entirely driven by manufacturing in the last 18 months. So that's inflationary. At the same time, this is new, but at the same time that you've got a lot of spend that just needs to happen to get to net zero. And whether or not that will materialise, I think the IRA gives us more conviction that it will. There's a sort of government's willingness that wasn't apparent even a couple of years ago to put money behind this. So I think those sort of disinflationary forces are changing on that front. And then at the same time, you've had a really terrible period for Labour. It's been a really bad period to just rely on your incomes. Great period if you just own capital and clearly kind of QE of 2009 onwards, just turbocharged asset returns. Sure. But yeah, for anyone who just lives off their income, real wages have done nothing or gone down in developed countries. And we think also that that's changing. That there's a shift in the power between capital and labour. You saw it before COVID. COVID kind of, we were talking about this just before we started, but it's slightly redressed the balance in terms of what employees now expect from their employers. It's also, at the same time as a cost of living crisis, empowered people to say, no, I need more. And you look at sort of labour union participation in the US, that's going up. Negotiating power in the UK has gone up as well. And I think wages are going to be almost the single most important factor. We look at sort of inflation historically. Wage inflation is at the core of what actually drives demand and makes inflation sustainable. And we are seeing pretty sticky wage inflation so far, both here and in the US.
Does that sort of suggest a return to the 70s? Does it have to be like that? Or, I mean, the trade union thing and labour participation and the politics is quite an interesting facet in all this, isn't it? There are some pretty strong parallels to the 70s, at least from my understanding.
Yeah, I think there are. I think it is obviously different. It rhymes, it's different, and it's probably not repeating in the same way to the sort of levels of inflation that we saw in the 70s. We would agree that there are lessons to be learned. Clearly there was an oil supply shock in the 70s, which was pretty major in terms of a catalyst for inflation. We do have oil supply challenges now, increasingly. We've noticed those over the last few months. But this is slightly different. And labour unions we look at participation was so much more powerful then than it is now. But there's the rate of change. It's now compared to the 2010s. You're just seeing there's a step change. And that's all that really needs to happen for inflation to be above the 2% that we've become so used to.
Sure.
And that's, I think the 2% is certainly priced into bond markets. I think equity investors also still just anchored to that being the norm. And I think anything to derail that very comfortable level of assets going up with very benign inflation, that has an impact on valuations that we haven't seen yet.
Yeah, I definitely agree with most of that. And then sort of moving on, if the fund's 25% equities, what is it in the rest of the fund that you've got at the moment that makes up the 75%?
Yeah, so it's a combination of the index-linked bonds I mentioned, That's the largest allocation. It's just under 40%. We have cash that used to be just cash and are now actually earning something on it. So it's mainly in short-dated gilts and treasuries. And then we've got just over 10% in gold. So inflation protection in out of those three legs, if that makes sense.
Gold brings me on neatly to the chart we've got here. So we've got a chart of gold in sterling terms going back to 1975-ish. And I think what's interesting about this, obviously in the late 70s, gold went through the roof from kind of £70 an ounce, this would be, to 300, so probably quadrupled in the late 70s. And then actually it went nowhere for another 30 years, did it? It was sort of still around the same levels, if not a bit lower, in the early noughties, and then went on another tear for a sort of 10-year period from 2000 to 2011. It's had another sort of 5-10 years where it's not really done a huge amount. I mean, if you sort of eyeball the chart, do you think that we are entering a period where gold perhaps does provide a good hedge and some good returns and good ballast in portfolios?
Yeah, so we were kind of looking at gold returns. I think since we've owned it in the mandate, it's annualised 12%, which a lot of equity investors would never think of as being what gold delivers. I think it's a really attractive asset class.
Is that in sterling terms? Or?
That's in sterling terms, yeah, thank you. So it is important to say we don't hedge the gold as well. There is clearly that sort of inverse correlation between the dollar and gold.
Would you hedge?
No, we sort of see it as actually it dampens the volatility because the dollar's strong. Often gold will be weaker, but also we're protecting against risks to the purchasing power of our investors' capital, and that is in sterling. So actually it gives us that wider protection. I think also we have quite a lot of dollar exposure, so we're quite positive on the dollar. But in terms of where we go from here with gold, our view is that you don't need gold if you're in an environment of real growth where inflation is stable, where interest rates are potentially sort of at a kind of medium level, but there's a sort of positive sloping yield curve, most importantly. So you've actually just got an environment of strong real growth. That's not going to be good for gold. In a period where you've got a challenge to growth, which we still think you do, but you've also got a response to that, which is up until recently just monetary unorthodoxy and monetary easing, but also fiscal easing. That's the environment where actually you need protection against that devaluation of paper currencies. And clearly we saw that gold benefited a lot during the period of QE in the 2010s. And we think now you've got QE is potentially not a tool in the toolbox today, but certainly fiscal spending, even before we're going into a recession, is very much there as something that governments and policymakers will use to try and stimulate the economy, and we would expect actually QE to return in a much more difficult environment. You saw it in the banking crisis of this spring. So that environment just creates more money in the system. It devalues any currency that you can print, and unfortunately both sterling and the dollar are within that, so we need to protect, and those environments are inflationary, and gold has tended to be a great hedge in inflation.
So have you been increasing the gold weighting in the portfolio?
So we did increase it a little bit during COVID. We have a royalty and streaming company called Franco-Nevada. A colleague of mine's actually out visiting them today, in seeing one of their mines in South America. It's actually in Peru.
Peru, okay.
Yeah. So they have investments in a variety of different mining operations, but they are not a miner, which is really important. So they're not responsible for the capex, so that entails for the array of external factors that can ultimately derail your production.
There's
much
no
more capital
consistency
light.
Return on invested capital is not a thing, is it?
No,
like the
it's
price
not a
goes
thing
up,
for
they spend
mining
loads of money
companies.
and then it all blows up.
And your variable costs
your variable costs goes through the roof. Yeah. And then sort of allied to the kind of gold question, slightly tongue-in-cheek, but any thoughts or discussions about crypto as part of the mix?
Yeah, so we got asked a lot about this in 2021, and this might be the first time, which is good, contrarian, although I know it's done a little bit better recently. We think crypto is a really interesting invention from the point of view, particularly of the technology underpinning it. So I think the blockchain is what you're already seeing as a variety of use cases which are pretty transformative, particularly in sort of tracking goods. When it comes to crypto as an investment that's appropriate for our strategy is a definite no. The volatility is
Also, it's off the charts. What is it? 60% annualized or something?
Yeah, it is. In terms of the talking about drawdowns, I think there's a 99% drawdown at one point for Bitcoin, and there are lots of other reasons as well. But it's not really a currency, as you say. If it's so volatile, can it really be a medium of exchange?
It's a commodity, really, isn't it? I would have thought.
Yeah, it's a sort of NASDAQ commodity. It behaves really in tandem with risk assets and risk appetite. So in our view, that's really not providing any diversification in the portfolio, whereas gold tends to do pretty well when markets sell off. And last year was a really good case in point for that, when crypto sold off, but actually gold in sterling terms was positive.
To come back to, bonds and index-linked gilts. So, if I was clever enough 2 years ago, we were sort of in the pandemic, and I would have thought, do you know what, I think inflation's going to go up because supply chain issues and all that stuff, and then there was war in Ukraine, the oil price went up, so I think I'm going to get loads of inflation. So what I'm going to go and do is buy some index-linked gilts, because that will protect me. We've got a chart here of an index-linked gilt ETF. This is UK index-linked government bonds, which goes back 5 years. And you can see from the start of 2022, the total return on index-linked gilts basically fell 50% during 2022 when inflation went from 2 to 15 and back again. Why didn't my index-linked gilts work for me last year?
Yeah, so the problem, and people often call them inflation-linked, which again just should be a hedge. The prices are driven by two things. One is expectations of inflation, particularly if you're at the longer dated. It's all about what the market thinks inflation is going to be over that time frame. So not necessarily related to inflation today. And the second driver of those returns is the nominal yield. So, and this is not to get too technical, but the combination of that inflation expectation and nominal or just conventional yields is the real yield, and that's what drives the price. So ideally, what you want for an inflation-linked bond to do well is expectations for yields and interest rates to be low and expectations for inflation to be high.
Right.
And actually what you had last year was yields rose as interest rates started rising, expectations that would persist into the future increased. Inflation, and even now, was just expected to stay anchored to this 2% that we're so used to. So you just had this double whammy of the index-linked inflation part, the break-even, doing absolutely nothing for you, and yields really hurting you. And if you were, I think, on the long dated, it's the best example because that is the most sensitive to the change in those two things. And clearly, you could have lost a lot of money. I would also say, because we didn't own any UK gilts last year and no index-linked gilts, they started in 2022, they started the year incredibly expensive. So it's a bit of a weird market because a lot of pension funds have to buy them to match liabilities, and that effectively has a forced buyer. It's pushed the real yield way, way low, i.e. the price got to pretty egregious valuations, and that real yield was nearly -4 at the start of 2022. What that means, -4 real yield, you are locking in, if you hold that for, was that 30 year?
That was 25 year.
Yeah, okay. So if you hold that for 25 years, over that period, you'll get an annualized -4 plus inflation.
Right.
So if inflation's 4, you're not losing money, but you're locking in a real return that's negative. So for us, it wasn't a particularly attractive start point.
And we've got a chart here of real yields, both in the US and UK, and the red line here is UK real 10-year real yields, which, as you point out, was -3, -3.5 at the start of 2022. And that's fallen pretty consistently over the last 10, 15 years. Now, obviously, the last 12, 18 months, we've seen a pretty abrupt round trip in real yields. So do you just want to explain, if you buy an index-linked gilt that's 10-year, the real yield is what you earn after inflation, right? So go on, I'll leave you explain it.
Yeah. So, and what's great here is that this is actually far more interesting. So there's a massive move, as you said, in both UK and US, particularly in the UK. So UK's gone from negative 3.5 at the 10-year to positive, what was in the middle of August, positive nearly sort of 1.5. So you have, if you hold that for 10 years, you're getting 1.5 plus whatever inflation turns out to be. So
That's
inflation,
still RPI, right?
and it's still RPI for the next 7 years, and then in 2030 they're moving to CPIH, which is lower, so it's an effective default. Amazing that hasn't got very much attention. It is reflected in the price movements, we think, broadly.
Right.
But yeah, you've got to be aware that RPI tends to be higher, so it's actually a better deal from the government. No surprises that they've slightly backtracked on that. But yeah, you will get, at the moment it's about positive one, so you'll get positive 1 plus whatever inflation is. So if inflation is 5% annualized, but with upside if inflation turns out to be higher, which is frankly pretty attractive prospect. And in an environment where we think inflation's going to be higher and at least more volatile, we expect people are going to start paying up for these. But at the moment, no, that it hasn't yet happened. And we think, again, it's this like frogs in boiling water. We're so used to inflation just coming back down and staying down. And we almost got this sort of blind faith in central bankers that they are going to just quell this inflationary storm. And actually, we don't need to worry about RPI being anything above its long-term average, which is around 3.5. And that's roughly what's priced into UK index-linked gilts.
So if we get inflation averaging 3% on RPI for the next 10 years, plus you get when you get 4% a year nominal, for taking basically no credit risk, right? Because it's UK government risk, no inflation risk. You've got a bit of volatility. And that sort of, compared to, I mean, it's quite interesting what we do in the sense that we sit down with, individuals and talk about investments. For the last 10 years, we have been in the TINA environment. There is no alternative. Cash has been yielding you 0, gilts been yielding you 1. If you want, most of our kind of clients, roughly speaking, want 5% a year. For the sake of, I'll just plug that number over. 5% a year is what I want on my capital. Well, you've not been able to get that by owning anything like this, cash, short-dated bonds. It's been impossible. So you've had to go out the risk spectrum, whether that's equities or buy-to-lets or crypto or gold or whatever it is. People have been pushed out of the risk spectrum. And what's interesting in the last kind of 18 months is we've seen an element of repricing, but there doesn't seem to have been, correct me if I'm wrong, if you're now getting 1% real yield on UK index-linked gilt, 2% on US TIPS, Treasury and inflation protection securities, why have we not seen kind of more capital flow back to those assets?
Out of equities.
And in particular out of
risk
equities.
Assets, agreed. We don't think it makes sense, but I think probably talking of catalyst, but maybe the thing that provokes investors to realise, actually, hang on, I'm taking a lot of risk on my equity investments for very little risk premium. There's, you look on the earnings yield on the S&P, for example, versus the 10-year. I don't know if you might have a ready-made chart.
Chart here of the valuation on the US equity market, which is a forward valuation. So it's got the S&P on kind of 18 times earnings, based on what I think probably 10% growth in the earnings. I think is what's baked into estimates.
I think that's the next 12 months.
So it's about 20 times spot, isn't it? I think, roughly speaking.
Yeah, and you have to go, so we've come down a bit from the sort of stratosphere of 21, but you actually, before then, you have to go back as far as 2002 to see a valuation that is that high on the S&P. So yeah, as you say, people still clearly happy to take equity risk. I think this year to date's probably confirmed that bias in their minds, because AI has given another leg to a bubble. That's what we sometimes call an echo bubble, and that it has similarities to what happened last year, or what happened in 2021 rather. But it is our strong view that people will realise the risk they're taking as and when equities and as and when earnings expectations move down. Yeah. So if we go into a recession, suddenly, even if you're invested in Microsoft, people are going to be spending less on business software, and maybe that valuation of nearly 30 times, I'm not prepared to pay that. I'm getting very little return for my risk here. I think I'll just take the sure thing of 5. And I think it really takes that realization of the risk that people are taking. Last year was a little bit of that. So you have seen some reallocation away from equities. If you take out the Magnificent Seven from the S&P. The equal weighted S&P has not really done anything this year. So there is a little bit of a shift, but we think it really takes a proper downgrade of the earnings cycle.
And Microsoft's still a reasonable holding in the portfolio. It's been in the portfolio for a long time.
Yeah.
I mean, it's clearly not cheap, 32 times.
Yeah, it's on sort of 28 forward earnings today, yeah. And look, we want to own that unless the investment case changes, but we expect to own that for at least the next 5 to 10 years. It's a great company, and actually in AI, it will generate returns from that we can see. It will not be immune, and none of our stocks will be if we go into a recession. And so we had 6% in Microsoft in 2021. We now have just a little over 2%. So it's really sizing that for the risk, but also being on the front foot so we can add to that holdings that's quite small.
And in the index linked and sort of direct gilt, direct treasury positions, are you quite short dated, or are you adding duration?
Yeah, predominantly short dated. I think what everyone is learning about the index linked market, to your point, last year, long dated, you rely on the market efficiently pricing in what inflation is going to do. So you're hostage to what the market thinks, both in terms of nominal yields, but also inflation expectations. And so it's much more speculative. With a short dated, we have predominantly sub 5 years in terms of our index linked exposure. You actually just receive what inflation turns out to be because you tend to hold those to maturity. So there's much less risk in terms of relying on a rational bond market.
But you're not holding those index linked because you expect inflation projections to change massively. It's just the real return and the opportunity you see from this point without actually much changing the landscape.
Yeah, so I think eventually those inflation expectations will change.
Okay. I think they'll go up?
I do think they'll go up. So if you look at the US, almost across the curve, it's around 2% is the break even. So that's what the bond market's pricing in for inflation. And what we've had, and your chart earlier, which shows that obviously inflation in the US got up to sort of 9%, it's now back down to just below 4%. It's sort of happening in a fairly straight line, absent the last month. And I think people are just extrapolating that. But as soon as and we would expect the response to the next recession to be quite a stimulative one, probably quite a strong fiscal response, given that that's sort of on the table now after COVID. We'd expect that to be quite inflationary in the aftermath. So it might take for us to go through a recession and see inflation
down.
perhaps even lower. But then if inflation starts, and you sort of talk about these double peaks that we saw in the 70s, if we get a second peak and people might actually start to realise, hang on, that wasn't just a one-off, that's something that's more persistent. And I think it will take that for inflation to actually stabilise or at least return to higher levels before people recalibrate that expectation.
And you touched on debt there, and we've got a couple of charts here. So the left-hand chart here is the cumulative change in the US Fed funds rate from March 2022 to date, and you can see in red how interest rates in the US have basically gone up by 5 percentage points in the space of a year, just over a year, which is far more aggressive and far further than any rate hiking cycle that we've seen. Notably, there was a very shallow rate rising cycle in December 15 to December 18, which is, rates went up 2% in 3 years, which was under Yellen and then Powell.
Probably. And then the pivot.
And then the pivot. The right-hand chart is probably the more interesting thing to come back to that point about. You touched on kind of governments and fiscal largesse and inflation and things. The quantum of debt. So this is the global quantum of debt between 1970 and today as a percentage of GDP. It's gone from 100% of GDP to 250% of GDP, with much of the rise kind of government debt. And governments have essentially taken a lot of debt off private balance sheets through QE, through the last 10 years, but also through the pandemic when they were effectively underwriting the economy. Like my sort of view is that you've got a big deficit in the US, and none of the politicians appear to want to address it. You've got the economy is effectively doing fine, and they've got an 8% deficit. If it goes into recession, that doesn't get any smaller. What is it? What kind of breaks here, or does anything break, or can we kind of continue this kind of facade that we appear to be in?
Yeah, it does help if you can get your central bank to buy your own debt.
Buy your own bonds.
So I think there is, particularly for the US and countries with monetary sovereignty, so the UK is included in that, and clearly Europe less so. There is an ability to just keep on printing. I think our major concern with this, and to your point on going from 100% of GDP to 250, it becomes a brake on growth. And particularly a brake on growth when your interest payments are no longer effectively zero. So we look at kind of also on a global level, debt to GDP across sectors, so across households, corporate and government, and that's well over 300% now. And if you just assumed a 2% rate of interest on that debt, you need to grow nominal GDP 6% just to pay the interest, two times 300. And that's quite a healthy level of growth. And suddenly if you go from 2 to 6, you're talking 18. So there's just no way that this can be good for the sort of long-term growth, but I just don't think it's sustainable, and it's why we think ultimately you need to have a period of financial repression to rebalance this, which effectively financial repression is having interest rates lower than your rate of inflation. And we've already got the inflation, but we question the sustainability of interest rates at this level. If inflation's coming back down to 2, and this is what's priced into bonds, which is why I think it's quite interesting, inflation of 2 and rates of 5, and that's a very strongly positive real rate, which is going to add to the debt. If you have, as you did after the Second World War, a period where actually your real rates are significantly negative, you bring down the value of that debt in real terms.
And I was about to say, effectively we're not dissimilar positions post-World War II. We had a huge debt load from the cost of the war, and you had rates were basically held. I mean, you had the sort of gold standard in those days, so it's not entirely comparable, but rates were basically 2 to 3% for 20 years.
They were held, and capital controls. And I think, you can start playing with all sorts of ways, and obviously you've seen it in Australia already, Japan, yield curve control, which is something that has been tried and might be a way that central bankers kind of consider, okay, how can we enable this financial repression? But I think we're quite far from that yet, because at the moment it's all about beating inflation. But thinking about the debt, I think when growth starts to tail off is going to be a major priority.
Cheerful stuff, eh? It's all right for Hughes. He's fixed on his mortgage for another 10 years yet. He's all right.
Oh, well done.
He's all right. Any sort of final thoughts that you want to give us? I mean, sort of, relatively negative on equities, index-linked bonds, gold, all useful assets in the portfolio, getting paid to own those things, which I think is, nice.
I think for people that listen, we the equity stance is, if you've got 25% equities, which sectors do you like, or where do you think there is opportunity? Yeah,
so I think there will be new sectors that maybe weren't interesting 10 years ago, that will be in a slightly more inflationary environment and a slightly more capex intensive environment as well. So we're sort of looking at a few more industrial businesses, not compromising on the quality of the company, so still really good return businesses, which they've got that margin structure. They tend to be, fairly critical and small ticket items. So in terms of cyclicality, we try and avoid the really cyclical end of markets. We never invest, for example, in house builders. But that return profile, I think, will be added to a much better growth rate if we go into a period of decarbonisation, but also a period of more manufacturing spend. So I think that's something that hasn't been in the portfolio so much in the past, but could be in the future. And then,
have you added anything recently that you can talk about, or you?
Yeah, so we do have companies that maybe you more associate with a Trojan Fund, which are branded consumer goods businesses. One of which we've added recently, which is Heineken. And Heineken's had a pretty torrid time since COVID. Actually, I think the share price is now below where it was. And in terms of that as just a great brand that we can see, particularly in emerging markets, having a huge runway for growth. It's a family-owned business. It's very, very well managed and invested in, and it's premium beer. I mean, this is just going to benefit from particularly the emerging consumer whose wallet is going to be a lot bigger, and
Yeah.
their disposable income a lot larger in 10 years' time. So on a valuation of low to mid-teens, which is where we've been buying it, that is a sort of isolated, well, it's a minority of instances where actually you're really getting paid to take the risk.
Interesting.
We'll have a look at that.
You like Heineken, don't you?
No, well, partial, occasionally. Charlotte, thank you very much for your time
Thank you.
today.
Yeah,
Thanks
thank
very
you.
much.
That's great.
Thank you very much for joining us on this episode. Any questions, then do get in touch, jonathan.raymond@courseachieveit.com, and we hope to see you next time. Thanks very much.
Thank you.